Glenn, you've been hearing what we're talking about debt. I mean, basically we're not out of the woods yet. We're many years away from that. Firstly, what are your views on the crippling nature of debt when it comes to growth going forward?
It's interesting, clearly in front of this audience here, I don't have to preach anything. It seems like we're all aligned. We normally have much more controversial and confrontational discussions here. No, I think this is very problematic. In order to save the world in 2007, 2008, the states had to step in, bail out the banks, and their balance sheets are now very, very strained. Also, promises are made to the electorates because you want to get into government, you want to stay in government. I heard one of the European officials say, we know exactly what we have to do, we just don't know how to get re-elected if we do it. And that's the problem. You have to promise the electorate more and more and more. It's all unsustainable, it's all nonsense, and it's going to be a very difficult decade or maybe two ahead.
I mean, it's just looking at kind of some stats when it comes to debt. The top 13 OECD countries sitting with debt to GDP of above 90%. And studies show, the restricting nature of that kind of debt when it comes to growth going forward. It can kind of cut 1% off growth below trends. And that could last for around 23 years is what they're saying. So we've got 23 years if you start, from the financial crisis and beyond, that you're going to have a slow growth environment. What are your thoughts on those numbers?
Well, I don't think it has to be 23 years. We could have a crisis much before that and cleanse the system, and we could continue to grow thereafter. But I think a total focus on growth is part of the problem, etc. It's not necessarily healthy growth or sustainable growth. It's debt-driven growth. So I think GDP is very problematic in and of itself.
The timelines for this slow growth environment, how long is it going to last for? Is it more about adapting to the reality and not questioning how long it's going to, 23 years, 10 years, who knows?
It's going to be a long, long time. That is the one certainty. Look at Japan. Just look at the Nikkei and their economy. They peaked in 1990. And it's gone downhill ever since then. Gradually, they're becoming a smaller share of the total world's economy, and I think that we may find that the world economy starts to shrink, and that will be terrible if one thinks of employment for countries like South Africa. It's going to mean a huge burden coming onto the state because it's not really productive to have to keep people alive, government grants and so on, and that's not going to be productive for the economies. So it could be 20 years. We cannot estimate it. I think that the solution hasn't been found. That is why we can't say how long it's going to do, except there is no solution in sight right now.
I think the big concern, if you look at Europe specifically, is the concern is that you're trying to make something appear as though it is something that it's not. So you've got huge debt levels, as you alluded to earlier, supporting stock exchanges, supporting bond markets trading at all-time lows, almost zero rates in Europe and in the US, completely unfundamentally driven, purely by a wall of debt that's out there looking for a home, that's not creating the outcome that we're looking for. And ultimately, I think what's going to end up happening is economies are going to have to go and focus inward again, not worry so much about this global feed off each other, trade that's happening. You're going to have to look at yourself domestically.
How does the globalized world start focusing inwards? It's almost going backwards in some sense.
We're going to have to, because the problem is at the moment is that we're so tied in to what's happening in other economies that, as we've seen in South Africa, it drags us down as well. We're not worrying enough about what's happening in our own domestic economy that's creating growth and creating sustainability in our own domestic economy, as we're seeing in the likes of Europe and we're seeing in the likes of the US. There's too much concern about, we've been too export driven or too driven by global trade and less focused on what we can actually generate within our own domestic economy, and that's the concern. And if we want sustainability, we have to start looking inward again, or this thing at some point is going to blow.
What do we need to focus on then?
Well, I think it's very interesting if we look at some very big macro factors, for example, demographics. Japan is an aging population. Its growth is going to slow naturally anyway. So they're fighting a bit against the inevitable. Yes, they peaked in 1990. It's been a terrible 30 years since, and no growth since then, and stock market's down almost 80% from their then highs. Europe is aging as well, so Europe has some fundamental problems that are not going to easily be resolved. In addition to just the debt, we have other problems taking place. Government is too big as a proportion of the economy. And the studies that we show, everyone knows the Reinhardt and Rogoff one, about 90% debt to GDP. It's also not just their growth slows, it slows at an increasing rate as you move beyond that. And we have Japan sitting at 250% debt to GDP. So
Okay,
Japan
so
is really problematic.
But yeah, before we wrap this up, because we don't have a lot of time left, from an investment perspective, give us your views right now in managing your money and managing your wealth in an environment like this that is uncertain, and you have to accept low growth rates, uncertainty, and of course this big debt pile that is going to have ramifications.
But I think it's very interesting. You can have a very big disconnect between the economy and the stock markets, and we've seen that for the last 3.5 years. Growth has not been great, and yet your markets are up dramatically. And why? Because the liquidity has been pumped into the system. When does that tip over and stop happening? I'm not exactly sure, but there is that risk out there as well. So you can have the disconnect between bad economic growth, and often does happen. Bad economic growth, lower interest rates, stock markets up. But I think into this environment, we've been talking about 3 themes, and I think they stay very, very relevant now. You need growth, you need yield, and you need quality. And that's actually what's been performing very strongly. If you look at our South African stock market, if you've seen growth, certainly, those parts of the market have gone up. And that's typically been the retail and the consumer part of the market, as opposed to the mining sector, where all our managers keep saying, wonderful value, but the sector never goes up.